Okay, silver. The price just took a massive dive. We saw speculators, leveraged traders getting absolutely hammered globally. So the big question, right? Was that it? Was that the death blow for the bull market? Or maybe just the shakeout before the real fireworks start? We're talking about an asset that, well, resource legend Rick Rule says pays rent like no other when it actually moves. Huge, fast swings. And it's so volatile, its actual global supply has kind of stumped the experts for, what, decades? Today, we're getting into Rule's latest take. He's arguing this recent drop wasn't really a crash. He calls it a reset.
Yeah.
Yeah, designed specifically to, quote, take out the trash. We'll look at some surprising signs, like these absolutely crazy borrowing rates that hint a physical squeeze is already happening, and maybe why silver's future is kind of locked in by centuries of, well, currency problems, especially in South Asia. Okay, let's get into it.
Right. Our focus here is crystal clear. Pulling out the key forward-looking stuff from Rick Rule's recent silver analysis. We really need to grasp the why behind his thinking. Why? Even if silver dipped from, say, $50 back to $40, the long-term picture holds strong. And crucially, how you might position yourself for what he sees as a truly historic move coming. Hey, and if you want more insights like this, straight from top names in finance, stuff you can use to build your own view, you need to subscribe to CredEdge right now. Seriously, don't wait, click subscribe.
Okay, let's start with that market drama. Rule looked at the recent pretty brutal action leverage traders liquidated, the momentum guys wiped out, and he wasn't fazed. He actually saw it as a good thing. What does he call this volatility? Why defend it when it feels so destructive?
He calls it a cleansing fire, or a reset. And the key point is, he stresses that this isn't a failure of the bull market. It's actually a necessary part of it. You know, this kind of violent price swing, it shakes out the speculators, the ones who just jumped in late based on charts, not fundamentals. Rule sees it as cleaning up the system, reducing that speculative risk.
Okay, but the selling was intense. A lot of bears would just call that heavy selling pressure, maybe manipulation. What makes Rule sure it's trash cleanup versus just weakness?
It's about the result, he argues, not just the action itself. He's pretty clear that even a drop from, say, $50 down to $40 wouldn't actually derail the main precious metals bull run. It just cleans out the weak hands. That volatility, it's like the price of admission for silver. It takes folks who just recently got the religion of silver, as he puts it, and boom, a 15% drop turns them right back into doubters.
Yeah.
But if you're disciplined, if you understand the long game, Rule thinks you almost welcome it because it cuts through the noise.
It's about having the stomach for that volatility, seeing the swing as part of the asset's potential power.
Exactly right. His famous line is that silver pays so much rent when it moves. What he means is the gains can be so huge, so fast, that you can afford to be early. You just absolutely cannot afford to be late. The price action we just saw. In his view, that's just the market efficiently booting out the overleveraged players who weren't set up right.
Now, when you hear about silver in the news, it's often about industrial uses, right? Solar panels, electronics, that kind of thing. Demand there is growing, but is that industrial side what really pushes the silver price?
Well, Rule's experience, and he's seen 3 big silver bull markets, tells him pretty strongly. No, industrial demand is more like predictable background noise. What really matters, he insists, is investment demand. It's that difference, the imbalance between investment buyers and sellers. That's the real engine for price moves, according to Rule. Simple as that.
That really flies in the face of common thinking, doesn't it? Given how much industry actually consumes, is there history to back that up, that investment demand is king?
Oh, yeah. He points to a specific major spike in silver way back. It happened after demand from photography, which used to be a huge industrial user, started to fade away. So industrial use was shrinking, but the price went nuts. The only way he could explain it was looking at the investment side. There were just way more buyers stacking silver than sellers letting it go. Now, Rule definitely gets the importance of solar demand growing, water treatment, silver's anti-germ properties, all that. He acknowledges it, but he maintains those industrial factors are secondary because they change relatively slowly, predictably. Investment demand, that can shift on a dime violently. That's what creates the truly big historical price moves.
Okay, beyond demand, there's something weird about the supply side too, right? Makes silver kind of unique.
Definitely. He calls silver an odd metal because its supply just doesn't respond normally to price. It's inelastic. See, most new silver doesn't come from mines digging primarily for silver. It comes from recycling, or more often, as a byproduct when mining other metals.
Like copper or lead.
It's exactly. Copper, zinc, lead. And that creates this weird paradox. When the silver price shoots up, It doesn't automatically mean more silver mines get built. Why? Because the huge decision to build a mine, costing billions, that's driven by the price of the main metal, like copper, not the silver they might get on the side. So this structure means supply reacts much slower, much tighter than for other metals. It adds fuel to those explosive price moves. And hey, before we dig into silver's role as money, which is really key to its long-term story, just a quick reminder. Getting the real edge in resources often means sifting through complex data analyst calls. To get those crucial forward-looking insights synthesized clearly, you need cred edge. Don't rely on yesterday's news. Subscribe today. Get synthesizing.
All right, let's talk identity. Rule often talks about silver having this monetary soul. Is it really still a monetary metal, or has gold completely taken over that job?
Rule's position is very firm on this. He calls silver a monetary metal in drag. His point is, what does a monetary metal do? It acts as a lasting store of value and sometimes an informal way to exchange value. Silver absolutely still fits that bill in large parts of the world.
And where is that monetary soul most obvious today? Where does that history of currency trouble really cement its role?
You see it most clearly in South Asia. We're talking India, Pakistan, Bangladesh, Sri Lanka. Hundreds of millions of people there who, frankly, can't afford to stack gold regularly. But they have centuries, literally 1,000 years, of experience with governments messing with their money, debasing currency, confiscation. They are savers deep down, and they just don't trust paper promises or sometimes even banks. So when they have savings, what do they buy? Physical silver. Often jewelry, sometimes small bars they can keep easily. In that huge culturally ingrained way, yes, it's absolutely acting as a monetary metal, a long-term savings tool. Rule even mentions seeing firsthand in places like Dubai how silver isn't just stored value, but can function as a secondary medium of exchange, especially for bigger ticket items like commodities or land deals.
Right. Speaking of storing it, with gold, we have a pretty good idea of the above-ground stock, right? Around 216,000 tons. But silver's different. Rule says the total supply is a massive unknown.
It really is one of the great mysteries of the world, as he says. Unlike gold, where the investable stock is roughly estimated, maybe $15 trillion worth, nobody, but nobody, can accurately tell you how much silver is actually out there above ground. Think about all that held as family jewelry, savings, unregistered household wealth, especially across Asia. It's just unquantifiable.
I remember that story about Warren Buffett's silver play back in the day. That kind of proved how unpredictable the supply is, didn't it?
Well, that's a perfect example of the supply blind spot. Rule tells the story. Buffett was thought to hold a huge chunk, maybe 15%, 20% even, of the known world supply. Naturally, the price started rocketing up. But then, seemingly out of nowhere, the price just got crushed. Rule emphasizes this wasn't some big conspiracy or manipulation. It was unexpected supply hitting the market pouring out of India. Why? Because peasant farmers there got hit by a double whammy, a terrible harvest, and bad currency fluctuations against the dollar. They faced a horrible choice. Sell the family silver they'd saved for generations or watch their families go hungry. They made the only human choice possible. And suddenly, this massive amount of silver, which nobody had accounted for, flooded the market. That experience, Rule says, basically forced him to give up trying to precisely measure global supply or time the silver market based purely on predicting shortages. It's just too unpredictable.
Hang on, though. If Rule gave up trying to measure supply because it's unknowable, and he says industrial demand is secondary, how can an investor really lean on fundamentals for this historic move he sees coming? Isn't he basically making a bet on investment demand rushing into a market where the fundamental supply is a giant question mark?
That's a very fair point, a sharp critique. But Rule kind of flips that uncertainty. Because the supply is unknowable, he shifts focus to what is measurable, what is transparent right now. And that's the acute financial stress, the pain you can see in the leveraged paper markets. That unknowable physical supply forces him to look at the immediate financial indicators, which right now are flashing bright red.
Which brings us right to the most startling bit of data, the hard evidence suggesting a physical squeeze is actually happening now. We've talked about the why of the volatility, but what's the measurable pain point?
Okay, the current numbers, the quantitative data, it confirms a serious near-term physical squeeze. You have to look at silver lease rates. That's basically the interest rate you pay to borrow physical silver. Historically, maybe 3%, 4% was normal. The industry could handle that right now.
Yeah.
In some recent short-term contracts, those lease rates have just exploded. We're talking up to a catastrophic 35%.
Right, seriously, 35%? To borrow the physical metal. That's insane. That's not just cleaning house. That sounds like the plumbing of the market is genuinely breaking down somewhere. It forces a reaction.
It's completely unsustainable. Think about it. Traders often run on maybe 10%, 15% equity in commodity plays. You simply cannot survive at 35% borrowing cost. It's impossible. The second you're paying 3 times your expected profit just to hold the position, you're forced out. You get liquidated. So this metric, this 35% rate, it's the hard proof backing up Rule's idea that the recent volatility is just trash cleanup. The system is forcefully purging players who cannot withstand that kind of financial pressure. Rule sees these crazy high near-term rates as mainly a problem for those over-leveraged paper traders. For the long-term physical investor, it's actually a signal. It signals the physical market is incredibly tight. And long-term, he says, investors need to compare the value, the utility of holding precious metals versus holding, say, U.S. government debt like the 10-year Treasury.
Looking at that comparison is what keeps him structurally bullish on metals.
Okay, so looking ahead then, based on that bullish view, Rule often brings up Pierre Lasson's gold target, right? Something like $17,250 by 2030. And that's based on the idea the US dollar's purchasing power could fall by, what, 75% over the next decade because of fiscal issues? If gold's heading towards $17,000, what about silver? Emotional, volatile silver.
Yeah, Rule's usually careful about putting a specific number on silver, exactly because it's so emotional, as he calls it. He jokes its potential is almost limitless thanks to the stupidity of small groups of people, meaning the kind of speculative fever it can ignite. But he does point out, based on history, once silver really starts moving and begins to outperform gold, which often happens after gold makes its initial steady climb, silver's rate of increase tends to be at least double the percentage gain of gold, sometimes more. So, if gold does a 4x from here, is an 8x or 10x for silver out of the question? Historically, no, especially given that thin, inelastic supply we talked about and how investment demand can just swamp everything when it kicks in.
Okay, so let's tie this together for you, the listener. Rule's view. Recent volatility. Not the end, but a needed cleansing, removing risk. The real driver for a big move. Investment demand, not just industrial use. And maybe most critically, right now, those sky-high 35% lease rates. They're screaming that something really unusual, maybe painful for some, is happening behind the scenes in the physical market. A real shortage in the paper world.
That's the core thesis in a nutshell. And Rule's final takeaway is often that silver's wild swings, that volatility, that's exactly where the big opportunities lie for disciplined investors who get its monetary role and its quirky supply setup. You have to ride out the reset to capture the potential explosion.
So here's something to chew on. What actually happens to the silver price if or when all that unnoticed above-ground stock, the jewelry, the hidden savings around the world, starts getting drawn into the main market? And just how high do those lease rates have to go before that happens?
And look, if you want ongoing, unbiased analysis on these global resource shifts, monetary dynamics, the forward-looking stuff, you absolutely need Credit Edge. Don't get caught out by the volatility. Use the information. Subscribe right away so you don't miss what comes next.